Picture this. You walk into a shopping mall in Dalian, China. The lights are dim. The doors are locked. Inside, rows of beautiful furniture sit collecting dust. Armchairs that once cost 20,000 to 30,000 yuan each, now abandoned. This isn't just any store. This is Markor Home Furnishings, once a thriving retail chain that symbolized China's middle-class dream. Today, it's shuttering locations across the country, struggling to pay its employees, desperately pivoting to selling high-speed data cables just to survive. And here's the kicker. This isn't an isolated incident. This is happening everywhere in China right now. Before we dive deep into this unfolding economic disaster, make sure you hit that like button and subscribe to the channel because what you're about to discover will blow your mind. The story we're uncovering today isn't just about furniture stores closing or construction companies struggling. It's about the systematic collapse of an entire economic model that powered the world's second-largest economy for decades. And the ripple effects, they're touching every corner of the globe. Let me set the stage for you. China's real estate sector, once the beating heart of its economic miracle, accounting for nearly 30% of the country's GDP, is in total freefall. And when real estate crashes this hard, it doesn't fall alone. It takes everything downstream with it. Furniture retailers, cement producers, steel manufacturers, construction equipment makers, glass factories, home appliance companies, renovation firms, and thousands of suppliers are all drowning in the wreckage. The numbers are absolutely staggering. In 2021, China's property market was valued at 18.2 trillion yuan. By 2025, it's projected to crash to around 9 trillion yuan or less. That's a 50% collapse in just 4 years. Half the market gone, vanished. And this isn't some gradual decline we're talking about. This is an economic earthquake that's been gaining intensity year after year with no bottom in sight. Let's talk about Markor for a moment, because their story perfectly illustrates what's happening to thousands of companies right now. Markor International Home Furnishings started in 1990. For decades, they built an empire selling high-end furniture to China's growing middle class. They operated stores in major cities like Beijing, Shanghai, Tianjin, Hangzhou, Suzhou, Dalian, Chengdu, Chongqing, Wuhan, Shenzhen, Guangzhou, and Xiamen. They even partnered with American furniture retailer Ethan Allen to bring international design standards to China. At their peak, they represented success, quality, and the Chinese dream of homeownership and comfortable living. But then the real estate market collapsed, and suddenly, nobody was buying furniture anymore. Why would they? New home sales in China dropped from over 814.5 million square meters in 2024 to projections showing continued decline through 2025 and beyond. When people aren't buying homes, they're not buying furniture. It's that simple. Markor closed 27 underperforming stores in 2024, mainly in lower-tier cities where the property crisis hit hardest. They shut 4 more in the first half of 2025, then closed another 9 directly operated stores in the third quarter. Their revenue in 2024 was 3.39 billion yuan, down nearly 19% from 4.18 billion the previous year. Their losses? 863.61 million yuan, 86.5% worse than in 2023. Think about that for a second. A company that had been profitable for years is now hemorrhaging money so fast they're desperately trying to acquire a computing power cable company just to stay afloat. They're betting on high-speed data cables for AI infrastructure because their core furniture business is essentially dead. That's not a pivot. That's panic. But Markor's struggle pales in comparison to what happened to Easy Home, China's largest home furnishing retailer. This is where the story gets truly tragic. Wang Linpeng, the chairman and CEO of Easy Home, was once Hubei's richest man with a net worth of 36.8 billion yuan. He built his company from the ground up after taking over a furniture mall destroyed by fire in 1998. He orchestrated a controversial backdoor listing in 2019 that made him enormously wealthy. Easy Home operated 407 furniture malls for shopping malls, for modern department stores, and 165 supermarkets with annual gross merchandise volume of 122.2 billion yuan. Then the real estate crisis hit. In 2024, Easy Home's revenue fell 4% to 12.97 billion yuan. Net profit plunged 32% to 883 million yuan. The company was drowning in debt with about 4.3 billion yuan in non-current liabilities and short-term loans due within a year, but only 2.2 billion yuan in cash and cash equivalents. The math didn't work anymore. In April 2025, Wang Linpeng was detained by anti-corruption investigators in Wuhan. For over 3 months, he was held in what's called the Liuji system, a form of incommunicado detention in solitary confinement, where torture is reportedly rife. On July 23, he was released pending investigation. He returned to his duties at the company. 4 days later, on July 27, at 57 years old, Wang Linpeng jumped to his death from the attic of his suburban Beijing home. His death sent shockwaves through China's business community. But here's what's even more disturbing. Wang wasn't alone. He was the 4th private entrepreneur to take his own life in just 4 months. Zheng Yuzhou, founder of L&D Home, died on July 17th. Lu Wenchao of Shizi Elevator died on June 2nd. Bai Guangjuan, founder of Shaoxing Jindianzi Textile, died on April 16th. All of them were in their early to mid-50s. All were successful in the home furnishing and related industries. All came under disciplinary investigation. All died by suicide shortly after their release from the Liuji system. These weren't failures. These were titans of industry who built empires from nothing. And the property crisis destroyed them so completely that they saw no way out. Think about the psychological weight of that. These men watched decades of work, their entire legacies, crumble because the foundation beneath China's economy, real estate, simply collapsed. And it's not just furniture retailers suffering. Let's talk about the construction materials industries, the backbone of any real estate market. Cement production in China, which was already the world's largest by far, is in freefall. In the first 8 months of 2025, cement production declined 5% year-on-year to 1.11 billion tons. August production was 148 million tons, down 6% year-on-year. In July 2025, China produced its lowest monthly volume of cement since 2009 at just 146 million tons. Industry representatives are predicting another 5 to 8% decline in 2026. The reason is obvious. Reduced domestic demand from the prolonged real estate downturn and sluggish infrastructure investment. When you're not building new homes, you don't need cement. It's basic economics, but the scale is mind-boggling. Major cement companies are getting absolutely crushed. CNBM, one of the world's largest cement producers, saw sales revenue fall 14% to $24.8 billion in 2024. Sales of its basic building materials segment fell 23% to $12.5 billion. Operating profit from this segment decreased 45% to just $544 million. Anhui Conk, another giant, reported sales revenue down 36% to $12.4 billion and net profit down 25% to $1.01 billion. The steel industry is facing similar devastation. China has long been the world's dominant steel producer, accounting for over 1 billion tons of yearly production. But with real estate construction plummeting, demand for steel has collapsed. The government is now actively pushing an anti-involution campaign, encouraging consolidation in sectors burdened by overcapacity like steel, cement, and solar panels. Translation: they're admitting there's way too much supply and not nearly enough demand. Glass manufacturers, aluminum producers, construction equipment makers, they're all suffering the same fate. These industries expanded massively during China's real estate boom, betting that growth would continue forever. Now they're stuck with massive overcapacity, plummeting prices, and mountains of debt they can't service. Let's zoom out and look at the real estate developers themselves, because this is where the crisis originated. China Evergrande Group, once the world's most heavily indebted developer, with over $300 billion in debt, received a liquidation order in January 2024. Trading in its shares was suspended, and in August 2025, Evergrande was delisted from a Hong Kong stock exchange after being suspended for 18 months. Its shares became effectively worthless. The company's founder, Hui Ka-yen, was detained in China in September 2023 on suspicion of committing crimes. In 2024, China's securities regulator issued a fine of 4.2 billion yuan against Evergrande's subsidiary for violations including falsifying financial records. Hui himself was fined 47 million yuan and barred from China's securities markets for life. But Evergrande was just the beginning. Country Garden Holdings, once the largest private property developer in China, warned in August 2023 of a massive net loss for the first 6 months of that year, somewhere between 45 billion and 55 billion yuan. The company faced liquidation petitions after missing loan repayments and defaulting on multiple offshore bonds. Throughout 2024 and into 2025, Country Garden struggled to survive, with hearings repeatedly postponed as the company attempted to restructure its offshore debt. And then there's China Vanke, and this is where things get really serious. Unlike Evergrande or Country Garden, which were privately owned, Vanke is state-backed. Its largest shareholder is Shenzhen Metro, a state-owned firm that owns roughly 30% of the company. For years, Vanke was considered one of China's most stable developers, relatively conservative in its finances, closely connected to the state sector, enjoying easier access to funding than purely private developers. If any company had political protection, it was Vanke. But in 2025, even Vanke couldn't survive. The company reported a record 49.5 billion yuan, approximately $6.8 billion, annual loss for 2024. In March 2025, Vanke faced a liquidity crisis so severe that Chinese state media reported authorities had detained the company's CEO and that Vanke itself could face a takeover or reorganization. The Shenzhen government held closed-door meetings to plan stabilizing Vanke's finances. In November 2025, Vanke's bonds plunged after the state-backed company sought to delay an onshore bond repayment for the first time. Credit rating agencies downgraded Vanke repeatedly. S&P Global cut Vanke's ratings, citing expectations that the developer faces a substantial bond maturity wall over the next 6 months and heightened risks of forced restructuring. Fitch Ratings downgraded Vanke's long-term issuer default ratings, warning of imminent distress. By December 2025, Vanke was desperately trying to persuade bondholders to accept delayed payments. They won approval to extend a grace period for one bond, narrowly avoiding default, at least temporarily. But they failed to get approval to defer principal payment for 12 months, with creditors representing only 20% of the outstanding amount voting in favor, far short of the 90% required. Here's why bank matters so much. If a state-backed developer with strong political connections and access to government support can't survive, what does that say about the entire sector? It means the crisis has moved beyond punishing speculators. This is systemic failure. If even bank is losing liquidity, it means China's real estate financing system has ceased to function as a whole. The human toll of this crisis extends far beyond corporate boardrooms. Hundreds of thousands of Chinese families bought homes that were never completed. Developers collected their money up front through China's pre-sale system, where homes are sold before construction even begins. When the developers ran out of cash, construction stopped. Buyers are stuck paying mortgages on homes that don't exist, may never be completed, and are worth far less than they paid even if they do get finished. The psychological impact is devastating. For decades, Chinese families poured their life savings into real estate, believing it was the safest investment possible. Housing represented 70% of assets for urban households. When prices started falling, people felt poorer overnight. Consumer confidence collapsed. Spending dried up. In the past 5 years, household deposits in Chinese banks almost doubled as people hoarded cash, too afraid to spend or invest. This creates a vicious cycle. Falling home prices lead to reduced consumer spending, which leads to weaker economic growth, which leads to job insecurity, which leads to even less spending and more saving. Young people, facing job insecurity and modest income growth, are choosing to rent instead of buy. Marriage rates are falling. Birth rates are plummeting. The entire social fabric is fraying. And then there's the local government debt crisis, which is intimately tied to the property collapse. Local governments in China have long relied on land sales as a critical source of revenue. They would sell land use rights to property developers, generating massive income that funded infrastructure, public services, and local development. At the peak in 2021, land use rights sales brought in $1.21 trillion. By 2025, that number has crashed to an estimated $417 billion, less than a third of the peak. To make up for lost land sale revenues, local governments borrowed heavily through local government financing vehicles, or LGFVs. These are special-purpose entities set up to incur and hold debt off the books, a workaround to strict central government borrowing restrictions. LGFVs would use land controlled by local authorities as collateral for bank loans and bonds. As long as land values kept rising and sales kept flowing, the system worked. But when the property market collapsed, so did land values and land sales. Suddenly, LGFVs couldn't generate the cash flow needed to service their debts. Many relied on bank forbearance, essentially getting permission to delay payments, which shifted the pressure onto the banking system. The total debt raised directly by local governments and via their LGFVs now stands at around 134 trillion yuan, equal to roughly $19 trillion. The IMF estimates that the combined total of local governments' official debt and off-balance sheet borrowing reached 84% of GDP in 2024, up sharply from 62% in 2019. Using the IMF's augmented definition, which includes off-budget local obligations, China's general government debt is estimated at 124% of GDP, while total non-financial debt stands well above 300%. That's an almost incomprehensible number. For every dollar of economic output, there are $3 of debt sitting on balance sheets somewhere in the system. The geographic disparities make this even worse. Wealthier coastal provinces have lower debt ratios and better fiscal health. But poorer provinces in the north and west have massive debt burdens, reflecting large public investments to support regional growth, growing current expenditures, and reduced revenues from declining land lease incomes. These disparities threaten to widen regional income gaps and undermine the continued development of lagging regions. Local governments are now caught in an impossible situation. They need to provide essential services like education, healthcare, and public safety. But their revenues have collapsed and they're drowning in debt. Some are resorting to hiring freezes, delayed payments to contractors and suppliers, and tighter procurement. This local austerity compounds the economic drag, creating more unemployment and further weakening consumer confidence. Beijing has tried various measures to address the crisis, but so far nothing has worked. In September 2024, Chinese authorities announced a comprehensive set of policy measures, including interest rate cuts, lower down payment requirements, and the easing of purchase restrictions. In December 2022, the People's Bank of China launched a loan facility with a 200 billion yuan quota to help complete unfinished pre-sold homes. Banks barely participated. By the end of the third quarter of 2024, only 12.7 billion yuan, about 6% of the quota, had been drawn. In early 2024, Beijing introduced a city-level real estate financing coordination mechanism where local governments would compile project whitelists and recommend them directly to local bank branches. The idea was to streamline lending to developers for project completion. Private sector estimates suggest completing all unfinished pre-sold homes could require at least 3 trillion yuan. The government's programs aren't even close to that scale. In November 2024, Beijing launched a 3-year debt restructuring initiative to refinance 10 trillion yuan of hidden local government debt. The plan allows LGFVs to swap high-interest, short-term debt for longer-term, lower-cost bonds. It's bought some time, but it hasn't addressed the underlying problem. As long as LGFVs rely on fiscal subsidies and land sales revenue to service their debts, the risk of renewed crisis remains. S&P Global Ratings downgraded its outlook for China's property market in October 2025, projecting new home sales would drop 8% from the previous year to between 8.8 trillion and 9 trillion yuan. That's far worse than the 3% drop they had predicted in May. The analysts explained that homebuyer sentiment remains fragile, and the government needs to continue supporting the sector to restore confidence. But confidence, once shattered, is incredibly hard to rebuild. Inventory levels are still climbing. As of August 2025, completed but unsold housing inventory stood at 762 million square meters, up from 753 million square meters in December 2024. The inventory turnover ratio, calculated by dividing residential inventory by average monthly sales, peaked at 25.9 months in April 2025. It's shortened by 5 months since then, but at the current pace, it may take another year and a half for the clearance cycle to reach a relatively healthy range of 12 to 18 months. Some economists believe China's property market won't bottom out until the first half of 2027 at the earliest. That means at least 2 more years of pain, assuming policy measures become more effective and the government takes more aggressive action. But Beijing seems reluctant to provide the massive stimulus that would be required. Why? Because Chinese policymakers increasingly view the property sector as a drag that needs to shrink, not a pillar that needs propping up. Official rhetoric has shifted. At high-level policy meetings, Chinese leaders emphasize the need for measures to address the property market while simultaneously prioritizing technological development. The message is clear. Real estate's era of dominance is over. China needs to transition to a new growth model based on innovation, technology, and high-tech manufacturing, not construction and property speculation. Data from China's Statistics Bureau shows high-tech manufacturing grew 9.6% in the first 3 quarters of 2025 compared to the same period in 2024, outpacing the 6.2% growth in overall industrial production. But real estate investment fell 13.9%, extending the sector's decline. The property downturn pushed fixed asset investment into negative territory for the first time on record, excluding the COVID-19 pandemic. This two-speed economy, with exports and manufacturing as the strong track and consumption and property as the weak track, is unlikely to be sustainable. Exports have remained surprisingly strong despite mounting tariffs and trade restrictions, rising 5 to 6% in 2025. But relying on external demand to drive growth becomes problematic when your major trading partners are increasingly hostile. The Trump administration has threatened massive tariff increases. Europe is considering similar measures, and even some emerging economies are pushing back against Chinese exports. Looking ahead to 2026, economists expect China's economic growth to moderate to around 4.5%. 3 factors underpin this outlook. First, the property market downturn will continue working through the system. Second, the government will press ahead with its anti-involution campaign, encouraging consolidation in sectors burdened by overcapacity. Third, the contribution of net exports to GDP is expected to decline as protectionism rises globally. For companies like Markor, this means survival requires radical transformation. Their bet on high-speed data cables for AI infrastructure is essentially an admission that their traditional business model is dead. They're not alone. Thousands of Chinese companies that grew fat during the property boom are now scrambling to find new business lines, cutting costs to the bone, laying off employees, and praying they can outlast the crisis. But for many, it's too late. The wave of business failures, bankruptcies, and suicides among entrepreneurs tells a darker story. This isn't just creative destruction, where inefficient companies are replaced by better ones. This is the systematic dismantling of entire industries that employed millions of people and generated trillions in economic activity. The social implications are profound. China's urban unemployment rate officially sits at around 5.2% in 2025, up from 5.1% in 2024. But those numbers likely understate the real situation. Youth unemployment was so high that the government stopped publishing the data for months before revising its methodology. Job insecurity is rampant, especially among young people. Wage growth is stagnant. The promise of upward mobility that drove China's rise is evaporating. Housing prices in China's major cities have continued to fall even after the introduction of supportive measures. New home prices fell 0.4% month-on-month in November 2025, while second-hand home sales declined 0.7% year-on-year. In some cities, prices have fallen 20 to 30% from their peaks. For families who bought at the top of the market, the wealth destruction is catastrophic. The question everyone's asking is, what can Beijing do to fix this? The honest answer is there are no easy solutions. The scale of the debt, the extent of overcapacity, the depth of the property collapse, all of it is so massive that no single policy intervention can solve it. China needs comprehensive structural reforms that address the root causes of a crisis. First, China needs to reform its fiscal system to reduce local governments' dependence on land sales. This means establishing more sustainable revenue sources like property taxes, giving local governments a greater share of existing taxes, or increasing central government transfers. Without reliable alternative revenue streams, local governments will continue facing fiscal crises that undermine economic stability. Second, China needs to clean up the banking system. Non-performing loans tied to real estate are far higher than official figures suggest. Official NPL ratios stand at 1.8%, but real estimates range from 5 to 10%. Banks need to recognize losses, write off bad debts, and recapitalize to maintain lending capacity. This is painful but necessary to prevent a broader financial crisis. Third, China needs to accelerate completion of unfinished pre-sold homes. Millions of families are stuck paying mortgages on properties that don't exist. Completing these projects would restore some consumer confidence, reduce precautionary saving, and provide collateral value for bank balance sheets. But this requires massive funding, coordination between multiple stakeholders, and political will to prioritize home buyers over developers and local governments. Fourth, China needs to let housing prices find their natural level instead of trying to prop them up artificially. Price-to-income ratios in Chinese cities are still too high by international standards. For the market to clear, prices need to fall further. This is painful for existing homeowners but necessary for younger generations to afford housing and for the market to eventually stabilize. Fifth, China needs to support affected workers and industries through the transition. Millions of people work in construction, real estate, furniture, cement, steel, and related industries. As these sectors shrink, workers need retraining programs, unemployment benefits, and support finding jobs in growing sectors like technology and services. The maturity wall facing LGFVs is staggering. Sizable tranches of LGFV bonds fall due every quarter. Many won't be able to refinance at any reasonable cost. Some won't be able to refinance at all. When these entities default, the losses cascade through the financial system. Banks that lent to LGFVs face losses. Bond investors take haircuts. Suppliers and contractors that worked on LGFV projects don't get paid. Employees of LGFV-funded entities lose jobs. Local governments lose a key financing mechanism. Chinese banks are trying to maintain stability by prioritizing higher-quality borrowers and avoiding aggressive loan growth. But this creates its own problems. Small and medium-sized private enterprises, which employ the majority of Chinese workers, struggle to access credit. State-owned enterprises get preferential treatment even if they're less efficient. Credit flows to politically favored sectors rather than where it would generate the best economic returns. This misallocation of capital makes the overall economy less productive and dynamic. The government's push for industry consolidation in sectors with overcapacity will inevitably lead to more bankruptcies and unemployment. When you have 50 cement companies competing in a market that only needs 20, 30 companies have to disappear or merge. Same for steel, glass, furniture manufacturing, and many other industries. The companies that survive will be larger and more efficient, but the social cost of getting there includes millions of lost jobs. Some analysts argue that China's property crisis might actually benefit the economy in the long run. Housing prices were unsustainably high, pricing out young people and creating social tensions. Resources were being wasted on excess construction when they could be better used for innovation and technology development. A correction was inevitable and necessary to rebalance the economy toward more sustainable growth. There's some truth to this perspective. China's per capita GDP is still only about 1/5 of the United States. The country has enormous potential for productivity growth, technological advancement, and rising living standards. If China can successfully transition from an investment-led growth model based on property and infrastructure to a consumption and innovation-led model, it could sustain solid growth for decades. But transitions are hard. Japan tried to make a similar shift after its bubble burst and struggled for decades. The United States made the transition from manufacturing to services and technology over many years with significant social disruption. There's no guarantee China can pull off this transformation smoothly, especially while managing a debt crisis, demographic decline, and increasingly hostile international environment. What we're witnessing right now with stores like Markor closing locations, entrepreneurs like Wang Linpeng taking their lives, and major developers like Vanke facing insolvency, these are not isolated incidents. They're symptoms of a profound structural transformation happening across the world's most populous country and second-largest economy. The old model of growth based on property speculation, debt-fueled construction, and ever-rising land prices is over. What replaces it remains uncertain. For the millions of workers employed in real estate and related industries, for the hundreds of millions of families who invested their life savings in property, for the local governments that built their budgets on land sales, for the banks that lent trillions based on property collateral, the pain is very real and very immediate. These aren't abstract economic statistics. They're people's livelihoods, dreams, and futures. As we watch this crisis unfold through 2025 and beyond, remember that China's property collapse affects more than just China. In our interconnected global economy, what happens in Beijing, Shanghai, and Shenzhen ripples out to New York, London, Sydney, Sao Paulo, and everywhere in between. Chinese demand for commodities affects prices worldwide. Chinese exports flooding global markets affect industries in every country. Chinese economic slowdown affects multinational corporations' earnings and stock prices. The fundamental question is whether China's government has the will and the ability to implement the reforms necessary to work through this crisis without triggering broader economic collapse or social unrest. So far, the approach has been muddling through with incremental measures. That might be enough to avoid immediate disaster, but it likely means years of subpar growth, persistent deflation, weak consumer confidence, and ongoing financial stress. For furniture retailers like Markor, cement producers like CNBM and Anhui Conk, real estate developers like Evergrande, Country Garden, and Vanke, and thousands of other companies across the property ecosystem, the brutal truth is that many won't survive. They expanded based on assumptions about continued property market growth that proved catastrophically wrong. Their business models no longer work in the new reality of declining home sales, falling prices, and overcapacity. The human cost of this transformation is immeasurable. Jobs lost, careers destroyed, life savings evaporated, dreams deferred or abandoned entirely. Entrepreneurs driven to suicide by circumstances beyond their control. Families trapped in mortgages for homes that may never be completed. Young people giving up on homeownership, marriage, and having children because the economic foundation has crumbled beneath them. As we wrap up this deep dive into China's property crisis and its devastating impact on furniture retailers, construction materials producers, and the entire economic system built on real estate, I want you to think about the broader implications. We're watching in real time as one of history's largest economic miracles confronts the consequences of unsustainable growth. How China navigates this crisis will shape not just its own future, but the future of the global economy. If this story shocked you, if you learned something new about the interconnected nature of modern economies, if you want to stay informed about these crucial developments, make sure you're subscribed to this channel and hit that notification bell. Share this video with anyone who needs to understand what's really happening in China beyond the official propaganda and sanitized news reports. The story of companies like Markor transforming from furniture retailers to data cable suppliers, the tragedy of entrepreneurs like Wang Linpeng choosing death over facing impossible circumstances, the systematic collapse of industries from cement to steel to glass, this is all part of a larger narrative about China's economic transition and the human cost of that transition. These aren't just business stories. They're human stories about struggle, adaptation, failure, and occasionally survival against overwhelming odds. Thanks for watching. Stay informed, stay critical, and remember that behind every economic statistic, every percentage point of GDP growth or decline, every bond default and corporate bankruptcy, there are real people whose lives are being dramatically affected. The collapse of China's property-linked giants isn't just an economic event. It's a human tragedy unfolding on a massive scale, and its consequences will be felt for years to come.